Welcome to the deep dive. Our mission today, well, think of it like a crash course in finding out what's really going on inside a company financially. We want to cut through, the jargon and the simple profit numbers, get straight to the heart of its financial health. So today we're digging into cash flow analysis. We'll be looking closely at the statement of cash flows. Think of this as your shortcut to understanding if a company is truly vibrant, financially speaking. Because in business, there's this one rule you just can't ignore.
Yeah, that's the absolute golden rule. Cash is king. Always has been, always will be. I mean, you can't pay your staff, you can't buy inventory, certainly can't invest in growing the business with just, paper profits. This deep dive is all about liquidity. Does the company actually have the hard cash right now to pay its bills,
Yeah.
to grab opportunities? It really is the difference between a business that's thriving and one that's, constantly just scrambling to keep its head above water.
Exactly. So the main goal for you, listening in, is to really get why looking at cash flow, specifically this statement of cash flows, is often way more revealing than just focusing on that net profit number everyone talks about. We really have to start there, right? But making that absolutely crucial distinction.
Absolutely vital. The difference between earnings, which you might know as net income or profit, and actual cash, it's huge. See, earnings get recognized using something called accrual accounting. That's how most public companies do it. It basically means you record a sale or an expense when the transaction happens, not necessarily when the cash actually changes hands.
Okay, right. Let's use that classic example everyone bumps into, accounts receivable. Say a company makes a huge sale. Fantastic. They record the revenue straight away, book the profit. They might even have to pay taxes on that profit now. But what if they gave the customer, say, 90 days to actually pay the bill?
Exactly. So on paper, they look profitable. Great quarter. But if they've got a big loan payment due next week and that cash hasn't landed in their account yet, they could actually default.
Wow, so they could be profitable and still go under.
It happens. That timing gap, the lag between making the sale and collecting the cash, that's the absolute core of cash flow management. And the statement of cash flows, the SCF, that's the tool. It's the definitive report that bridges that gap. It shows you exactly where the cash came from and where it went. Gives you that clear picture of liquidity.
Okay, so this SCF report, it's structured, right? It's not just one big number.
That's right. It's broken down very neatly into 3 key sections, 3 pillars, if you like. And when you add up the cash flow from these 3 areas, you get the total change in the company's cash balance over that period.
And those 3 are operations, investing, and financing.
You got it. Operations, investing, and financing. Let's maybe start with the first one, cash flow from operations, or CFO. This is really the engine room. It tells you about the cash generated from the company's main day-to-day business, what it actually does. So if you run a bakery, this is the cash coming in from selling bread and cakes, minus the cash you actually paid out for flour, sugar, wages, your rent, electricity, that kind of thing.
Okay, but hang on. When I look at the CFO section on a real statement, I see things like changes in accounts receivable and accounts payable listed. How does that fit with day-to-day cash?
Good question. That's the crucial adjustment we were just talking about, linking the accrual accounting back to actual cash. So if accounts receivable goes up, it means customers owe you more money than before. You made sales, recorded the earnings.
But you haven't collected the cash yet.
Precisely. So to find the actual cash from operations, you have to subtract that increase in receivables from your net income.
Okay. And accounts payable, if that goes up.
That's the flip side. It means you've received goods or services, maybe supplies, but you haven't paid your suppliers yet. So that cash is still sitting in your hike account, at least temporarily. It counts as a cash inflow for that period in the CFO calculation.
Got it. So it adjusts net income for those timing differences in collecting cash and paying bills.
Exactly. And the big takeaway here, the really important insight. If a company consistently shows positive CFO, strong positive cash flow from operations, it means the core business is basically funding itself. It's generating enough cash, just doing what it does to keep going without constantly needing outside cash infusions.
That sounds like a really healthy sign. Self-sufficient.
It's probably the strongest sign of a healthy, sustainable business.
Okay, so if the operations are generating cash, where does that cash sometimes go? That brings us to the second section, right? Investing activities, cash flow from investing, or CFI. Yeah, this section tracks the money spent on long-term assets, things that are meant to help the company grow or operate in the future. You often see outflows here. These are usually called capital expenditures, or CapEx. That's cash spent buying things like new machinery, buildings, maybe even acquiring a whole other company. Big ticket items.
Right. And inflows in this section, that would be cash coming in from selling off those kinds of long-term assets. Selling an old factory, maybe divesting a subsidiary. And investors, they watch this section like hawks.
Why the intense focus here?
Well, they want to see if management is reinvesting in the business to stay competitive, to grow. Are they buying new tech, expanding production, or are they neglecting investment? Now, sometimes you'll see consistently negative CFI because of heavy spending, heavy CapEx. That can be a good sign, believe it or not.
Negative cash flow being good. How's that?
It often signals ambition. It means the company is investing aggressively now, betting on future growth and profits. They're spending cash today to make more cash tomorrow. You just need context.
Okay, makes sense. So operations is the core business cash. Investing is about long-term assets. What's the third piece?
Yeah.
Financing.
Cash flow from financing, or CFF, exactly. This tracks how a company interacts with its owners and lenders, how it raises money and how it pays it back. So inflows here are typically cash raised from issuing new shares of stock to investors or from taking out new loans from banks or bondholders.
And the outflows, paying back loans.
Paying back loan principal, yes. Also, using cash to buy back its own stock from the market stock buybacks. And, crucially for many investors, this is where you see the actual cash being paid out as dividends.
Dividends. So this section is key if you're an income investor.
Absolutely essential. You know, a company can report high net income, high earnings, but that doesn't guarantee a dividend payment. You need to look at the CFF section to see if they're actually physically paying out cash to shareholders. Net income doesn't pay dividends. Cold, hard cash does.
Okay, that lays out the map really clearly. Operations, investing, financing. 3 distinct stories about cash. But just knowing the net change isn't enough, is it? You mentioned getting past the simple total. How do we assess the quality of the cash flow?
Great question. That's moving into more advanced analysis. And the single most important metric here is probably free cash flow, FCF.
Free cash flow. Heard that term a lot. What is it exactly?
It's actually quite straightforward to calculate usually. You take the net cash flow from operations, that first section, the CFO.
Right, the core business cash.
And you subtract the capital expenditures, the CapEx, which is usually found in the investing section.
So FCF, operating cash flow minus CapEx.
Yeah.
Okay. What does that number tell us? Why is it free?
Think of it this way. It's the cash generated by the business after it has paid for its day-to-day operations and after it has reinvested enough to maintain its existing assets. That's the CapEx part. So it's the cash that's truly free for management to use for other things. Optional things, you might say.
Like the company's fund money. Is that too simple?
Well, maybe a little simple, but it captures the idea. It's the discretionary cash. It's the cash available to, say, pay down debt ahead of schedule or pay dividends to shareholders or buy back stock or make that big strategic acquisition or fund a major new R&D project, all without needing to borrow more or sell off assets.
So high and consistent FCF is a really powerful sign of financial strength and flexibility.
Overwhelmingly so. It signals a company that's not just surviving, but thriving and has options.
Now, you also mentioned ratios for comparison. How do those help assess quality?
Ratios help put the numbers in context, especially comparing against the company's own history or against its competitors. A useful one is operating cash flow divided by net sales, CFO sales.
Okay, what does that show?
It tells you, as a percentage, how much actual cash the company generates from each dollar of sales revenue it reports.
So higher is better. Like 15 cents of cash for every dollar of sales is better than 10 cents.
Generally, yes, higher is better. It suggests efficiency. But the real value is tracking it over time. Is it improving or declining? And how does it stack up against peers in the same industry? If your company generates 15 cents, but the industry leader generates 25 cents, well, that tells you there might be room for improvement in managing working capital or operations.
Gotcha. Compare and track.
Exactly. There's another one, comprehensive free cash flow coverage. That's FCF divided by CFO.
FCF divided by operating cash flow. What's the insight there?
A higher percentage suggests that a larger portion of the cash generated by operations is actually translating into free cash flow after necessary reinvestment. Again, it points towards efficiency in managing capital spending relative to the cash the business throws off.
Okay, these metrics, FCF and the ratios, they give us a deeper view. But are there specific warning signs, red flags we should look for when analyzing these statements?
Oh, absolutely. You can't just see a positive total cash flow number at the bottom and think everything's fine. The details matter.
What's a major red flag then? Something that should really make you pause.
I think one of the biggest dangers, and you see this sometimes, is a particular combination. You see declining or even negative operating cash flow.
So the core business is losing cash.
Right. And at the same time, you see positive cash flow from investing.
Positive investing cash flow. Doesn't that usually mean spending on assets? How can it be positive?
It's positive when the company is selling more assets than it's buying, selling off property, equipment, maybe subsidiaries.
Uh, so negative CFO plus positive CFI. What's the danger signal there?
Think about it. The core business isn't generating enough cash to survive, negative CFO. So the company is selling off its long-term productive assets, positive CFI, just to raise cash to cover its operating expenses.
Wow, that sounds desperate. Like selling the furniture to pay the heating bill.
That's a perfect analogy. It's fundamentally unsustainable. They're essentially liquidating the company's future productive capacity just to meet today's payroll or rent. That is a massive red flag. The business model itself might be broken.
Okay, that's a critical one to watch for. Selling assets to cover operating losses.
Definitely. Also, just generally, excessive reliance on financing activities, constantly issuing new debt or stock just to stay afloat can be a warning sign too. Or frequent asset sales without a clear strategic reason.
You mentioned context earlier.
Yeah.
Are there times when negative cash flow isn't a red flag?
Yes, absolutely. And this is crucial. Remember, the cash flow statement looks backwards. It reports on the past. Short-term negative cash flow, especially negative FCF, isn't always bad. Think about a fast-growing startup, maybe in tech or biotech.
Correct.
They might have just raised a huge amount of money from investors. That'd be a big inflow in the financing section. And now they're spending it like crazy. Huge negative cash flow from operations, maybe, as they build staff and scale up before revenues catch up. Huge negative cash flow from investing as they buy servers, lab equipment, build factories, big capex.
So lots of cash going out. Negative
Oh,
flow.
right. But in that context, it's likely a positive sign. It shows they're investing heavily based on expectations of significant future growth and profitability. So context is everything. You can't just apply rules blindly.
That makes sense. Stage of the company matters.
Yeah.
One last technical point, maybe. You mentioned accrual accounting earlier. How does that relate to how these statements are actually put together? Are there different methods?
Yeah, good point. So most public companies use accrual accounting, like we said, revenue recognized when earned, expenses when incurred. There's also cash accounting, simpler, where you only record things when cash actually moves. That's usually for smaller businesses.
So for the big companies using accrual, how do they create the statement of cash flows?
There are technically two ways, the direct method and the indirect method. The direct method actually lists out the major categories of cash receipts, like cash collected from customers, and cash payments, like cash paid to suppliers, employees. It's arguably clearer to understand the actual cash movements.
But that sense of but coming.
But it's harder to prepare, and crucially, it doesn't directly link back to the net income figure that companies report on their main income statement. So almost all large corporations use the indirect method for the operating section.
The indirect method, how does that work?
It starts with that net income number from the accrual-based income statement. Then it makes a series of adjustments to convert that net income figure into actual cash flow from operations. It adds back non-cash expenses like depreciation.
Because depreciation reduces profit, but doesn't actually use cash.
Exactly. And then it adjusts for those changes in working capital accounts we discussed, receivables, payables, inventory. It's basically a reconciliation exercise.
So it gets you to the same CFO number, just via a different route, starting from net income.
Precisely. The end number for CFO is the same, regardless of method. But the indirect method is just far more common in practice. The key thing is understanding what that final CFO number represents.
Okay, I think we've covered a lot of ground here. From the basics of cash versus profit, through the three sections into FCF and even the red flags. It feels like we've really done a deep dive. You, the listener, should now have, hopefully, a much better toolkit to look past those simple profit headlines.
Yeah, I hope so. It's about assessing that true financial vibrancy, that resilience, because the bottom line really is this. Sustained positive cash flow, especially that strong free cash flow we talked about, it indicates a company that's generally in a strong position. It means they're likely self-sufficient. They can meet their bills. They can fund growth. They can handle economic bumps in the road without constantly running back to investors or banks for help.
FCF really seems like the key indicator for long-term health.
It's definitely one of the most critical, yes, a strong predictor of stability and future potential. But Here's maybe a final thought to leave you with, something to mull over. We've talked about how the cash flow statement is like a report card on past performance.
Right.
It tells you what happened.
Looking backwards.
Knowing you're running low on cash or that your FCF is tight or negative, well, that's important information, but it's only half the battle. The real test, the real skill, is what management does next. How proactive are they? Do they see the trends in these numbers and take action?
Action like.
Like securing your financing before things get critical, or making tough decisions to cut expenses, finding ways to boost sales or collect cash faster, using this analysis to manage the future. So the question for you, the learner, to really think about is this. If you were running that company and you saw your free cash flow looking weak or negative, which lever would you pull first? Would you prioritize cutting costs immediately? Or would you focus first on securing more capital, maybe more debt or equity? What's your first move to improve that financial stability? And more importantly, why that choice over the others? Something to consider.